Something feels off in the markets right now. Mortgage rates aren't falling the way they're supposed to. Stocks move up and down without any clear reason. And even when the Federal Reserve talks about cutting rates, financial conditions still feel tight. It's subtle, but you can feel it. Liquidity is getting tighter. And if you've been paying attention, you've probably noticed it too. Because beneath the surface, something much bigger is changing. Something structural. Most people blame inflation. Some blame artificial intelligence hype. Others blame politics or global tensions. But those explanations only scratch the surface. Because the real story doesn't start in the United States. It starts in Japan. To understand what's happening today, you have to go back to the early 1990s. At that time, Japan was one of the most powerful economies in the world. Its stock market was booming, its real estate prices were soaring. At one point, land in Tokyo was considered some of the most valuable in the world. And then, it all collapsed. Stocks crashed, real estate prices fell, banks were left holding massive losses, and Japan entered what would later be called the Lost Decades. For years, the economy barely moved. Growth disappeared, inflation vanished, wages stayed flat. It was as if time itself had slowed down. So the Bank of Japan stepped in. They cut interest rates. Then they cut them again. Eventually, rates hit zero. But even that wasn't enough. So they went further. They pushed interest rates below zero. And then introduced something even more extreme. Yield curve control. With this policy, the Bank of Japan effectively forced long-term interest rates to stay near zero, no matter what the market wanted. For years, borrowing money in Japan was almost free. But that created a problem. Because if you're an investor and your government bonds pay nothing, you can't just sit still. You have to look elsewhere. So Japanese capital started flowing out of the country, into global markets, into U.S. government bonds, into stock markets, into real estate, into emerging economies. And at the center of all this was one simple idea, the yen carry trade. It worked like this. You borrow money in Japan at extremely low interest rates. You convert that money into dollars, and then you invest it into assets that pay higher returns. The difference between what you earn and what you pay, that's your profit. Now imagine that strategy, not at a small scale, but at a massive global scale. Trillions of dollars moving across borders. For decades, this became one of the largest sources of liquidity in the world. It helped push stock markets higher. It helped fuel real estate booms. It helped drive global growth. But there was one assumption holding everything together, that Japanese interest rates would stay near zero forever. And for a long time, that assumption held. Until it didn't. In 2024, something changed. The Bank of Japan began to shift its policy. They ended yield curve control, and for the first time in 17 years, they started raising interest rates. At first, the move seemed small, but markets understood what it meant. Because it wasn't just a rate hike, it was a turning point. Suddenly, borrowing money in Japan wasn't as cheap anymore. Hedging currency risk became more expensive, and the math behind the carry trade started to break. That easy profit was no longer guaranteed. And when the math changes, the money moves. Capital that had been flowing out of Japan for decades started to reverse. Slowly, then all at once. This process is called repatriation, and it has massive consequences. Because for years, Japan wasn't just another investor. It was one of the most consistent buyers of global assets, especially U.S. debt. And here's where things get critical. The Federal Reserve controls short-term interest rates, but long-term rates are driven by supply and demand. If one of the biggest buyers steps back, someone else has to step in. And if they don't, yields rise. As Ray Dalio has said, the bond market is the backbone of everything. Because long-term interest rates don't just affect bonds, they affect everything. Mortgage rates stay high.
Even if the Fed cuts rates, stock valuations fall because future earnings are worth less today.
Corporate borrowing becomes more expensive, which slows down growth. And this is why the economy can feel tight, even when policy suggests it shouldn't. For decades, the global financial system benefited from something few people ever thought about: cheap money from Japan. But now that era is changing, and the shift isn't loud, it's not dramatic, it doesn't dominate headlines, but it is powerful and it is structural. Because the biggest risks in markets are never the obvious ones. They're the quiet shifts happening in the background. And right now, that shift is happening in Japan.